Welcome everyone to a very last minute series session. This is a tax special. Today's April 16th, and yes, about a day or two ago, we got this hilarious post. It's not really hilarious to that person, but it was a post about whether that person qualifies for REP or not, or real estate professional status, which is a really awesome unicorn status in the tax world. So Tony and I were trolling and back and forth, and then last minute decision, we decided to host this webinar. So thank you guys for tuning in. So without further ado, this is my probably very sleep deprived, caffeine high junkie friend, Tony Hoong of the CPA Dude.
All right, thanks, Annie. Appreciate it. Well, yeah, thanks for joining in here for some good old entertainment on the real estate professional status. So tonight's call more so just to go over like what it is, how does it help you, kind of just giving you like a 101 basic of what it is, and how can you really qualify for it. And I think it's a very like hidden part of the tax code, or like unclear gray area, but once you know how to actually use it, it's like the super dangerous tool on this side. So I'm gonna share my screen, and I'm just gonna like scroll around on the document, but I'm not gonna like walk it one by one. And just because it's a lengthy doc, so don't want to waste anyone's reading power. It's dry, but yeah. Also, if you want this, just text me on Instagram too. I can send it over. We shouldn't have like an automation set up for it. So everyone wants the guide here, but essentially real estate professional status, as Annie said, is just kind of be like, this is like the unicorn of tax strategies, I'd say. And generally speaking, it's hard to get, but once you can get it, oh man, this is how you save a ton of money. So like what it is that like the whole reason, like why do you even want it, is you really need to understand like how real estate is taxed for tax purposes. And real estate by definition it's just passive, right? All of it is passive income, passive losses, and passive income and passive losses do not offset active income. So I always say it's like oil and water, like the two just don't mix. But however, so in your active income, what is that? Active income is your W-2, your day job, like whatever you're doing there to earn money. Wherever you're trading your time for money, that's where it's at. So the two don't mix. So generally speaking, real estate, you're always going to have passive losses, generally speaking, because of depreciation. But you can't use those losses on your active income unless you have real estate professional status. So that's why you want to get it and why you need to get it. And essentially, this is just a carve out of the tax code here, where it just says like, hey, if you hop through these hoops, you will be able to become a real estate professional status and turn it into a unicorn and save a whole bunch of money on taxes. And this is what the rich people do, right? Like how they can leverage like real estate to save money on taxes. So the big thing on this side of like, like I just want to iterate is like all rental real estate is always passive. And sometimes it's good. It can actually offset your passive investment. So if you're doing some K1 investing in buddies' businesses, and you're just a silent partner, the losses from real estate actually can help you out. But I know everyone wants to squeeze out more than just that. And they really want to offset the active income, and you have to hop through the hoops. So, going over benefit wise is, like we said, ordinary income, offset that. This is a sneaky tax that gets on a lot of people, net investment income tax. So net investment income tax, long story short, is if you make too much money, they're going to kill you for another 3.8% on net investment income tax. So real estate, if it's active, you will not pay net investment income tax. So you're going to save almost another 4% on taxes. But if you don't qualify for it and you're past the modified adjusted gross income amount for that year, you will pay the 3.8% on that side. And then the big part is this depreciation. Like depreciation is great. I always say it's the eighth world wonder of the world. Can't see, feel, touch it, but it's how you can save a ton. And depreciation, there's a few flavors. I'm not going to go into it tonight just because it's very dense. But there's straight line, there's accelerated, and bonus depreciation. So many flavors of depreciation. But the big part is that these paper losses will actually offset your active income if you have real estate professional status. And then this is like when you use cost segregation, bonus depreciation to really do it, or else, cost segs may not make sense for you unless you're that profitable on other properties, or if you have like short-term rentals, or if you have, your mom and pop exceptions that you can, you can sign up for. So those are like your depreciation, those are the benefits there. So, just going over like a high level here. Scenario A is that if you're W-2 making 300 grand and you have losses, paper losses, of course, so you're like money rich, but paper poor, is you have $100,000 loss. That $100,000 loss is passive and your taxable income is still 300K. But if you're reps and say you're married and you're able to qualify for reps, it's the same scenario, 300K, 100K as a loss. So that's 100K reduces your taxable income. Now your taxable income is 200K. So, pretending that you're a 30%, 35% rate between Fed and state, it'd save you $35,000 in taxes. So there's like a new car for you or a nice trip or I don't know, part of your furnishings for your Airbnb, whatever you want to name it. But that's like the great, the good, now everything in life I always say has a catch 22. Like if it's too good to be true, it is probably too good to be true. Like I don't know anything that is that true without some catch. So the big part is like, how do you have to do it? So I say you have to like bust out your tax acrobatics here, and you really need to get flexible and work more or less. So the first part is more than 50% of your time is spent in the trades or businesses of real estate. So this is like you actually working on the property, working in real estate. So over 50% of your time has to be in real estate. And this is where most people fail. Like even as much as like Annie talks about Sarah, does all Sarah events, become a Sarah influencer. She's not a real estate professional just because, she spent so much time more than her day job doing this, but she still won't qualify on that side. So over 50% of your time, and this is just straight hours. So if you work a full-time job and that's 2,080 hours, and you still want to qualify for real estate professional, you have to work 2,081 hours. But that's like 4,000 hours. And I mean, I own a company. I don't work 4,000 hours. So, I mean, if you want to work that hard, be my guest. But I mean, I own a firm. I don't even work that much. And then this one is you have to have at least 750 hours in the trades or businesses of real estate. And this is one part I want to call it for a confusion standpoint that I see often is that if you're a married couple, like you have to have like one spouse's time qualify for that for the 750-hour test. We'll dig into material participation later, which is it can actually be a joint effort. But these are the first two hoops that you have to meet. And this one, more than 50% of the time, this is where most people fail and on this side. So 750 hours, you can probably do it. And I think that's where a lot of people are like, 750 hours is actually it's less than a part-time job, right? Like a part-time job's 1,040 hours. So this is just like a little bit between a part-time versus a part-time job. So, 750 hours, it's not that bad, right? If you just do it from a week perspective, 750 divided by 52 weeks, it's like 15 hours, right? 15 hours a week. Easy, I got this, our rental properties suck. I got to work on these all the time. But you will fail on the more than 50% of the time test. So those are the first two hoops you have to hop towards. And like the trade or business is the really important part here. So the 750 hours you have to meet in the trade or business. And I have a ton of them here. There's, property development, redevelopment, construction, reconstruction, acquisition, conversion. But they're your most common ones that you're going to see is going to be your property rental. So rental properties on the side. And then same thing, property management on this side, or proper operation. Like these three, I would say, are your ones that you're more or less going to get 750 hours on for you. Don't get me wrong, though, brokering is the easy one. So this is where a ton of people get confused like, hey, go get a real estate license. You'll become a real estate professional automatically. This is where people get confused, and that's not the case. Just because you go get your license, it does not automatically mean you qualify as a real estate professional. So don't think just because you have that, you're like, I got this, super nice car and I pay my dues, all that. It doesn't work like that. But that's why real estate agents, though, are actually one of the best candidates for real estate professional status because they're working their butts off on this side, right? Like Jane's working her butt off all the time, just showing homes, doing, marketing, putting stuff out. So that's why real estate agents are one of the best candidates for this side. But you can have other parts here too, right? Like acquisition, that's big on this side. If you're in construction too, but a whole bunch of different examples, but these are the most common ones that you can meet on this side. So these are the trades or businesses back up to here that you have to spend 750 hours with over 50% of your time in. So yeah, some social media influencing, not quite there yet, maybe one day. And now the third hoop, though, that's very overlooked is material participation. So material participation, though, this is where you're actually working in the activity that you want to offset against. So this is where most people get hung up, is that you'll do all the work here, but it doesn't, just because you do that does not automatically qualify you for real estate professional status. The material participation has to be on the property that you want to use to offset your income on. So you have to do this. It's a per property per unit test that you have to do. And there's 7 different like tests that you can do for it. You just have to meet one of them. And this is actually where your spouse can help you out on hour wise. So for this material participation, you really only want to do it on the properties that have a lot of depreciation. You don't really care to do it like, let's just say, for example, on you're a passive investor and you're just in a syndication and you're not doing anything, right? You don't really have material participation, but you want to do it on the properties where you do have a lot of depreciation. So the easiest one to meet is generally the 500-hour test. So you work 500 hours, anyone else can work more than you want it. Make sure you document your hours. The IRS will blow up your audit instantly through an hour log. So I was actually interviewing this dude. He was getting laid off from the IRS. And then he's just like, they just poke at it. This instant. You have an hour log? No, all right, I'm automatically disqualified. So you don't have hours, like you're gonna be in hot trouble. You're just gonna lose at the end of it. So have your hours. Here's an example that we made up here. 250 hours of showing units, 100 hours of maintenance, 75 hours on bookkeeping, 100 hours of putting property improvements in. So actually working on it. So 500 hours is one of the tests. The next test that you could do is the substantially all test. This is pretty much where you do everything. Like, do track your hours once again. You have to have like 500 hours, but you substantially performed all. The 100-hour test is you have 100 hours and no one else works more than you. So you don't have that 500 hours. You can have 2 properties and be a real estate agent, and you'll qualify if you have the 100-hour test. This one, the substantially all test, be real estate agent, property manager, have 1 rental, you'll still qualify. So there's so many variations of this. It's like the permutations are crazy. You just have to meet one of these tests. So these are like 3 more common tests. The other ones I really won't go into because you probably more or less most people won't meet them, I would say. So just remember, it's like to recap it, there's 3 things you have to do: 750 hours, over 50% of your time in the trades or business or real estate. And then number 3, you have to material participate in the build or like the property that you want to offset your income with. So that way it's kind of like a Venn diagram, like that middle area. Part of those hours could just be maintaining your own property. So that 750 hours can come from that. And then let's see here. We're going through on there. And then, the big part is the 500 hours. That, like I said, it is a per property test these are on. What you can do though is that, say you have 10 properties, you could group them all. So you have to make a grouping election, telling the IRS, hey, treat all these properties in this group as one. And if you meet the 500-hour test, then you'll just group them all that way. Because doing one property 500 hours is actually like really hard. Like that's legit actually a part-time job. But doing it aggregated, that will be your biggest part there. So your aggregation is really important on this side. And then this is just an election you put on your tax return. So, our tax software automatically pops it up. Like we just click the button, boom, it's there. But you're just saying, hey, I want to elect in this group these properties for material participation. So that's going to be material participation election wise. And then this is the part where people love to get creative in terms of like what are the hours I can do, right? The hours, like I would say, like, are they real hours? Like at the end of the day, are you actually working on it? Like it can be pretty straightforward. Like tell your like stare at your grandma's face and be like, hey, I did X, Y, Z. I actually worked on the property. So property management, maintenance, tenant screening, collecting rent, bookkeeping, researching some new properties. Do close on that property though. So I do want to put a caveat of closed properties on the side. So you can't just be like a massive researcher and like all you do is research. You actually have to buy the property. Contractors, travel time between properties, and then stuff investor activities. This is where you get in hot water. So on your logs, if you have a lot of investor activities, it won't go. So reviewing financial statements, monitoring them, studying the market. Hey, where should I go buy? Should I go buy in Dallas? Should I go buy in Minnesota? Should I go buy in Florida? Those are your biggest things. So like just actually work on the property on this side in order to do it. So just be very mindful of the logs. Logs, reps tracker, Clockify, those are all easy ones that you can use to track your time. And then yeah, iris wise, what are you gonna look for? Audit log, time log. If you have mileage, you're gonna look at your mileage logs. But when you do it, how long, what did you do? So that's kind of like examples that we drew up here. And then also documentation. So emails, text messages, phone records, like I said, mileage logs ready, receipts, bank statements. So just having this burden proof ready. And then also if you ever do get audited, don't take your sweet time to respond, like respond ASAP, because if you take a long time to respond, they think that you're kind of like taking like, oh, you don't got your shit in order and you don't have a log. You're going to create your log. So if you can respond ASAP towards that side, it's in your best favor to do that. So having that ready to go, and then a bigger thing of like, hey, where can you get in some hot water and how to get ready for it is just like if you're working W-2, it may be hard. How can you justify it? Because like they may poke at your pay stubs and be like, hey, this says 2,080 hours, but maybe you only worked 1,000 hours. You need to justify that. If you're not around the property, like are the hours real? Did you actually have 750 hours or not? Would be that. That's why Annie's always trying to match make here. Like, yeah, who's rich as hell that wants to marry someone in real estate, right? So that's two power couples on that side. And then your travel time. Some folks think that, hey, if I just go drive 6 hours to this property, all that 6 hours counts. It actually doesn't. The how mileage and time counts for travel is in between stops. So from your home to the property, so say if I bought like a home in Lake Tahoe, my drive from Richmond to Tahoe does not count on that side. And but if I go from like that home in Tahoe to Home Depot, that time would count. The mileage would count. It's all the stops in between. It can't be from your first place of residence to where you're working at. So yeah, on that side, pray to God no one gets audited on the side. I don't know. Trump's firing everyone anyway, so I think the audits are going to be less from that standpoint. And then yeah, there's some FAQ parts, but yeah, that's kind of like just real estate professional in a nutshell is like what activities qualify, what don't. Like kind of like knowing your audit log's your best friend. If you don't have a time log, it's not going to look pretty for you there. But essentially that's kind of like the 101 version of it. And I think just to like reiterate on that one post on that side, that I think the fact pattern was it they did brokering, but I don't think they closed a transaction. And then they still had a full-time job. I think that was the hard part was like the full-time job. Unless there's some way to prove out that you did the 50% or more, 750 hours material participation. I think that's where that post where it went astray on that CPA's fact pattern. And then the other portion too is just like it's your tax position at the end of the day, right? Like if you want to claim it, you can do it. I mean, I see people on TurboTax like fuck up their returns all the time. They click the box and then they get a massive loss. I'm like, bro, this thing's wrong, but I'm like, I didn't do it, so I don't care.
Tony, why don't
It's
we
your
pull up that? Actually, let's pull up that post first that inspired all of this talk, and then break it down in pieces. You want to do that? Want me to pull that up?
yeah, sounds good. You got it handy or should I look for it?
Oh, I have it because that it's been on my mind for like a day.
Oh, nice, nice. Yeah, we can break it down. And,
Okay.
I don't think there's like, it's always facts and circumstances on everything. And, Yeah, it's different positions that you want on that side. So I'm always like, hey, like, what do you think? Yeah, it's kind of up to you, your tax position. When you're working with CPA though, and the thing is that we do sign off on those returns, and they will actually penalize the CPA if it's a like a frivolous position. We had like no grounds for it. They'll penalize us 5 grand on that. So that's why if it just smells fishy, we're probably gonna not, unless like you're gonna pay me back the 5K. JK. Like, I wouldn't even go there just for ethical purposes.
Cool. So let me read this out. So this person is writing as an anonymous because my CPA might be in the group. I don't know if it's Tony. For
Probably.
context, I know. I'm hoping it's not actually your client because if it was your client, I was like, dude, you taught us better than that. Come on, right? All right, but going back to this, no more. You see, this person has a laugh, emoji. For context,
Nice. Nice.
we filed already, but I just had a heated discussion with the CPA on amending the tax return and wanted to get opinions from the group of experienced investors. Even before reading this, whoever is the CPA, thank you for having this heated discussion and stopping this person. Good job. Good job, CPA. So, I am a licensed real estate salesperson. However, with zero in sales for 2024. You know what? That kind of sounds like me. I
You wrote
know.
this code, bro. Oh
I
my
swear
God.
I
What
did
is this?
not write this.
Oh, okay. I was
But
like, oh my God, did you write this?
I
Oh,
don't know, that would be pretty funny. But like, for context for folks who are in here, I do have a real estate license in California, but I got it just for the trolls. I just really wanted something to look cool and I had my associate degree. But and I run SARE, but this dude, my CPA, still won't let me run for, do the RUP stuff. But that's another story. All right. But going back to this. So this person is licensed, however, has zero sales in 2024. I don't know how great of an agent this person is, but okay. Reason being, because I do it part-time and I have a demanding W-2 job slash income. I have a rental property with my siblings. Although, hey, it doesn't generate income because my family is living in it. So do you really call it a rental property when you have your family as squatters? I don't know. But we wanted to each claim depreciation on the property. So I asked my CPA if I qualified to be a real estate professional status, which the CPA say no, and challenged me with how can you justify zero in sales, yet you claim to spend over 758 hours performing real estate? That's on average 15 hours each week in addition to your W-2 full-time job. We went back and forth, and it ended up with, hey, if you get audited, it's no fun, but it's your choice. If you want to amend your return or and claim it, then fine. So that's the story. I don't know. It kind of sounds like my life, except I do spend 15 hours on SEER just trolling people, and I still don't count as REP. So
oh yeah. No, that's pretty good. Yeah, it's pretty good at but it actually kind of funny. It sounds like I talked to Eldar on my team because it almost kind of sounds like how he would say it because it's like I think I say it in a different way for me, but it's very similar. And I think the main part was the W-2. I think that was the hard part. Is that was like the W-2. Don't get me wrong, you can. I'm just saying like over 50% of your time, more than 750 hours. But then yeah, the sales part may be harder. And then the the material participation could have worked. I don't know, but if there's no money or rent being sent, then I think that's where it gets a little like raise the eyebrow. Like, was there actually real estate's was a rental income in play there? So those are a few things just to sniff out on that side. But yeah, like I said, it's just a tax position at the end of the day. Like it's your tax, your name on it. That whatever on that side. But if you just want to do things more by the book, I always tell like our clients, I'm like, yo, are you like on the spectrum of going to church, or are you on the spectrum of going to Vegas? Like, where do you want to be on this side? If you want to go to Vegas, cool, be my guest. If you want to go to church, be my guest. If you want to meet somewhere in the middle, I'll meet you there. So that's really where you want to take your tax positions. But I think real estate professional status, I think generally speaking, the easy combos for our clients that always have it is like you got the tech worker with the stay-at-home person, parent. You got the doctor with the real estate investor. You got the agent with the high W-2. Like those three are generally speaking the like our clientele is the go-to real estate professional people. So those are the easiest ones to meet. So if you're thinking about combinations, like who does this apply to, it'd be those folks specifically on that side. So I mean, it's good. I mean, it saves a lot of money. I mean, one of our clients, I used them as a case study. They were like, I'm gonna shave out like 600 grand in taxes with it. So it's like, hey, take that 600 grand and then just go reinvest that back into real estate and then go buy another like $2.4 million in real estate and rinse and repeat the same thing over and over again. So it's a good strategy. It's just like, it's not made for everyone on that side. But yeah, we can take questions if anyone wants on real estate professional status, or if you want free tax advice that's not applicable to you, or tax jokes. I got some bad tax jokes. So feel free to drop anything in the chat if you want on that side.
So going back into that person, so pretend that she does qualify. Let's skip the part where she says, she's just doing it part-time, and say she does qualify for it and she hasn't filed for it. But is it even worth it? Because in her situation, like that's not even like there's not even, getting rental or anything, and you have multiple people to split with. So let's kind of tweak that a little bit where pretend that is an income building thing,
Mhm.
and she is an RAP. But if she has siblings, what happens to all those depreciation stuff? Like, does it
So
split?
yes, so if you're like, just say you were a rep, you're a a real estate agent, and then you have a home that you split, it would just be pro rata. So it wouldn't depends on how much depreciation there would be, and then how much tax savings there would be. That's where you have to weigh out the benefit. So for example, like say if the thing is going to produce you, let's take $1 million home, as an example, just because millions scale easier here. Let me go calculator. So $1 million, and I'm just going to assume a 20% land value, probably way off, but close enough. And then I'm going to assume, oh, I guess this is an update, is that the current Tax Cuts and Jobs Act is trying to be extended. It did pass the House. Bonus depreciation hopefully should come back to 100%. The SALT cap's supposed to go to 25,000, which is huge. And then let's just pretend 100% bonus depreciation came back. On $1 million home, that could be up to like 160K conservatively. So 160K, and then let's say you had at the highest rate, and then you have siblings, I'm assuming two others, divide by three. That'd be like 53K of extra depreciation that you would take, and then give them the benefit of the doubt on the federal side, 37% on the side. So, they're making good money. The tax benefit would be like 19.7K. So depends on 19.7K is worth it to you or not. Like some people 19, like, whatever, I don't care. Some people 19 grand, I'll take it. It's really dependent on the person again. So yeah, I've seen all versions of it where we're like, no, 19K, because the blowback on it is that if you have a bad position, that's gonna be a 40% penalty. So 20 times 4, that's 8K in penalty. And then also you'll have interest, and they usually don't catch it for 3 years at least. Generally, audits come out in 3 years. So you'll have 7% accrued on 20 grand. What's that? 1,600 of interest a year, 16, 32, 48. So you're risking it for the biscuit for 12K. So it's 12K downside, 20K upside. It's kind of, once again, like I said, you go in church, you go to Vegas, take your bets, be my guest at the end of the day.
And then in terms of like kind of the tax logistics and paperwork, so if they were actually splitting the depreciation, how does that actually like come out to like each of the different people, like the pro rata part? Because then like is there a version of a K1 between them that they're, keeping track of all this?
If there's, yeah, usually it's not gonna be a K1. It's usually you take one income statement,
Yeah.
and then that CPA uses if they don't have the same CPA, that same income statement's given to all three CPAs.
Mm-hmm.
And then they should report it that way. In this report, they're like 33% of it. So
Oh,
generally speaking, yeah, when you're speaking like sharing homes, you want to have the same income statement. Otherwise, if it doesn't add up, I mean, you can already guess what's gonna happen. So yeah, you definitely want to be consistent in what you're doing.
So since they're reporting it all separately, that means that anonymous poster could technically claim like do the accelerated depreciation on her part, but then the rest of the folks they'll stick with the straight line depreciation or something.
They
Because
would.
or it actually doesn't even matter. Like they don't because they're not even doing cost seg on any of it.
Yeah. Yeah. I mean, once you have to do the cost segment to get accelerated. So
Oh, right,
since
okay.
it's done, the other people might as well take it and just bank in the losses because someone had to pay a couple grand for the study.
Mhm.
So might as well just knock it all out there. So yeah, it's a good, it's a good fun post, for sure. It's just differing opinions for sure. I think the people that don't know, like CPAs who don't know real estate as well, they may have a different answer, but I think real estate specific CPA would not probably take that position.
Cool.
You would just lose under audit is the issue. Yeah, it's an automatic L. So I don't know if anyone wants to take an automatic L on that side, and especially if there's like a $5,000 tax prepare penalty too, and be like, yeah, I'm not mad. Like I'm good on this side.
Mhm. Okay, then I'm
Yeah,
gonna take so other bits and pieces of her story because some of them are like very interesting and like because there's actually so many sections at first. Okay, so pretend Annie. Well, that's kind of true. I'm a real estate agent. I have a license, but I have zero income because I'm a shitty agent that only knows how to push business to other people or whatever. So can I still claim myself as an REP?
REP. You didn't need material participation. That's your missing part. Yeah, so you have to do 100 hours across all your properties. No one else works more than you, or 500 hours and across all properties and over 50% of your time.
What's the
Yeah.
thing is I'm an agent though, as in I'm calling all these people. I'm just really bad at my sales pitch. They're just not buying my shit, but I could give you a phone log of all the clients I'm talking to or things of trying to do ads.
I think so. I think yeah, if you actually go to like the IRS and it's facts and circumstances side of things, it would be so what number one, it would be you would have your 750 hours of showing that you tried to sell homes and then you had no other income, right? Or if you had a W-2, you have to outpace it. So if let's take the hypothetical that you're not a W-2, then that would actually work because you have no other income to show that you're doing. Then lastly is you just need to show material participation on the home that you want to depreciate against. But then the other issue is that we have no income offset. like,
So you're
like
saying I still need that 500 hours though for the material participation.
yeah, yeah, or 100 hours on that property by itself. But the issue is like, even if you qualify for all those, we don't have income to offset. That's the issue. Like we just hop through all these hoops, but what I'm going to take all these losses from my rental real estate. What am I going to apply it towards? That's the issue too.
Is the 500 either or? Can I just do the 500 and not do the 750 or no, I need
Oh
both.
no, you have to first meet the 750, then over 50% of the time, then you have to do material participation. That could be the 500, the 100 on that side. So it's always like a big Venn diagram that I always draw out for our clients. It's like a hard concept to understand though. It's very gray. I understand why it's so confusing.
Okay, how about another hypothetical?
Yeah, yeah.
Pretend hypothetical Annie quits her amazing W-2 job that fulfills her so much, meaning me, and I go back into running there full time, and I'm still taking people technically on field trips and properties and all that shit. And then I become a GP for one of Tony Lynn's deals. Like that, and then I just go hang out at his Dallas property for 500 hours, just sit there and hang out. Okay, and then will that count?
Pretty close. Yeah, pretty close. Yeah, I would say like if you had your yeah, if you didn't have any other job, and then Sarah's all volunteer time. There's you're not getting paid. Well, you don't get paid, so it's all volunteer time. Then your 750 hours of being a agent or doing deals, and then you could do material participation on the syndication. So it'd have to be the 500 hours though. It can't be the 100 hours just because you'll be at 500 hours working on that one specifically, and then all the depreciation that deal has, then you can actually offset your income, but you have no, what the issue is you have no income again, but yeah, hypothetically you have income. Let's just say hypothetically you have income, then it works.
Dude, this is hella hard to get to.
Yeah, yeah, yeah. Generally speaking, it's always like there's always like some breadwinner. The other person turns into the real estate investor because then they take care of the kids. That's like the go-to like combo, like that I always see. It's the easiest one too. Also to verify from a fact pattern if you ever get like audited, they're like, yo man, this dude's a doctor. The other person's like stay at home, watch the kids, and does all the real estate. And it's an easy fact pattern. But not everyone, their mom's a doctor, but you know, all our Asian parents wanted us to be one. But I didn't make it. Fun fact, I actually was a biology major in my first year. And then I was like, no, I'm out. I can't do this crap. Yeah.
At least you figured how to drop out of that really quick before you. Otherwise, the whole task world would be so sad without you.
Oh yeah, yeah. Yeah, my dad saw I got straight B's my freshman year. He's like, bro, you're going nowhere with this. Just quit. I'm like, all right, sounds good. So, you know, gets a fatherly love, but had a good point. Yeah. You're not getting to med school with straight B's.
B is like failure in Asian world.
Right? Yeah,
Mhm.
definitely. So, but counting was fun. So we're here. We're here now. Actually, another was it two other guys? No, three other guys on my team. We were all failed science majors. Well, it was like all turned accountants. So apparently, like a lot of accountants are just failed science majors. Like I was like, I didn't even know this about you, dude. But it was a fun story. We all found out about each other.
So how
Cool.
about if it's too hard to become a real estate professional? Any other loopholes?
Oh yeah, that's the that's where the short-term rental loophole is the is where the money's at. Now that's where Danny Wong, the king of STR, is actually too. Yeah, so yeah, he's the go-to guy for STRs and getting that done and manages them too. So management for STR turned around by Danny, he's got you. But no, the STR loophole, if you're W-2 and you can't become a real estate professional, the STR loophole is great. I always call it like the ugly duckling version of the real estate professional stats. A lot easier to meet. You just have to do average stay of 7 days or less throughout the whole year. And so you just have a lot of short stays. So total days divided by total stays. As long as that number is 7.0 or less, you'll qualify for that first prong. And then number two, you just have to material participate 100 hours. No one else works more than you. And then boom, run the cost seg, offset your active income, and you're good to go. Yeah, because I think Dan was working W-2 back in the day when he was doing it. So yeah, saved a ton of taxes. So yeah, STR loopholes the go-to is just do you want to handle the funsies part of an Airbnb? But it's a great cash cow for folks. So that's a good STR loophole is the go-to. A lot of the tech worker guys I work with, the tech bros, they do it. Yeah, and it just saves you a lot on that side. So if you can't do reps, just do the STR and loophole. You're just gonna be stuck with Airbnbs, but nothing bad with that. They make a lot of money. Hypothetically.
Is it as powerful, like the tax savings, compared to if you own
Equally the same. Yeah.
equal? Ooh.
Yeah, yeah. So on that $1 million home example, if you're gonna generate 160K of depreciation, as long as you meet reps or STR loophole, that's gonna reduce your active income. So yeah, if you can't meet reps, just go do STR loophole. I always like joke with my clients. I'm like, yo man, go buy an Airbnb. It's gonna save you a ton in taxes. But very few take me up on it. But some do. Yeah, some do. Yeah. Yeah. Easier said than done, for sure, though.
So Danny, are you an RAP yet at this rate, or are you sticking as just the short-term rental loophole?
That's funny because Tony and I were having this discussion earlier.
Were you really?
Yeah, slightly. Like, because yeah, I have to do my taxes now, and then I, I mean, no longer have that W-2 like, so got to figure that out.
So like, hey, you might as well, right?
Oh yeah, yeah. Because the that like going back to that one page I had on this side. So the trades or businesses actually, let me go share my screen again on this side. The up here, like what counts as what are the trades or businesses of real estate is right up here is property management. So that's one of the trades or businesses of real estate professional status. So yeah, Danny's got that going on right now. And then he's got his own, then he's dealing with his own properties too. So he's getting material participation on that side. So I just don't know how much depreciation is left though, because he squeezed everything out, dude. Like took everything out already. So what's left that we can be on there?
Buy another one.
Mm-hmm.
Although, the thing is with the property management, we also have to make sure clear, like if we have friends who are here that are actually a property manager, they technically shouldn't qualify because they're a W-2 employee.
Oh yeah, yeah. And this is like for yourself. Like you gotta be like Danny where you have your own company. Yeah.
Danny, good job. I love how we have our homies as our examples.
Right, right. Easiest use case is that way. Is the
Good job, class pres.
there you go. There you go.
Cool. So I have some questions in here. I have one from Marjorie. Would you qualify as a REP if you materially did all the maintenance and upgrades for all the 750 plus hours and then later hired a property manager? Ooh.
Yeah, I think for just that specific fact pattern, I think yeah, I would say so. So let me just go through it one by one. So you did 750 hours. So you're gonna meet the where's it at here? My trusty guide isn't so easy to navigate, but right here. All right, 750 hours. And then we're gonna assume that you have no other job. So then you had more than 50%. And then so that would count. And then lastly, you do have material participation because what did it say? Like they were doing all the
Yeah,
maintenance?
all the maintenance and the upgrades.
Yeah, all the maintenance and all the upgrades on that side. Yeah, so like right here, property operation. So you would have 500 hours, just group all your properties that way. Yeah, you have 750 hours. So at face value, without knowing all the facts, but as our lovely attorney friend Davis would always have to know, he has to know all the facts to make his conclusions. But yeah, at face value, that would count.
But then also what to clarify is that year one, when Marjorie does the 750 hours, she would count as RAP. But in year two, once she hires a property manager, she won't be able to fulfill those hours.
Oh yeah, yeah, yeah. And then the reps, it can be a per year thing too. It doesn't always have to meet every single year. Because if you rep it that one year and you go hard at it, actually a lot of folks that have kids, we try and play around with the numbers to see if it can work. Because they'll have a kid and then be like, hey, let me just go manage my properties full time. Then just go run cost segs on all the properties, do a change of accounting method, bring all the depreciation they never took before, and have a banger year. So yeah, that'd work. Yeah.
So what does the kid have to do with it? Is it because they
Oh,
just
they pop out a kid and then they're not working W-2 anymore. So let's say you have a kid in March and then you got 9 months to go get your 750 hours over 50% of your time, material participation. So yeah, that's where it can work out pretty well. So I guess if you're family planning, try to pop out your kid earlier in the year if you want to get rep status.
Or remember like when we went to Linfinity, the other way is just get laid off.
Yeah, just getting laid off. Oh
Just
yeah,
get off. That's another good excuse for everyone just going and becoming an RAP.
yeah, that was the go-to. Oh man, was it Edison?
Yeah, that was pretty hilarious. How did the whole panel just like, wait, I got laid off. Person number two, I got laid off. And then I was like, by Ashley, please don't say you got laid off. And she's like, I got laid off by Tesla.
Everyone gets like, oh man, it's grim. Yeah.
That was pretty funny. I don't know if it was intentional or not, but I was like, hey, you know what? In this political economy, you know what? I just escaped my first layoff and I'm fine. But I'm like, you know what? If I wasn't, do I really want to become a real estate agent? Answer is still no, though.
Oh yeah.
Still
Mhm.
too hard. Next question is, do you percent, huh? Do you percent of audit risk for folks who use, do you know the percent of the audit risk for folks who use the STR loophole?
I don't know the percentage. I do know like we've had zero so far, knock on wood. So yeah, we got zero so far. And my mentor, he's had some, but their docs have been fine. So it really comes back to your hours log and proving that. So once you have all the documentation in place, you're good to go. So I wouldn't be like audits. I always say too, is it's like, hey, it's just an audit. Like, cool. Here's your paperwork. All right, moving on. It's kind of like getting stopped or something. Like here you go, moving on. So percentage risk though, I wouldn't say it's like super high. but it's not super low by any means. Just because the computer system, it can get triggered by like, hey, Schedule E that has um, a higher loss, they could select it for more. But the more audits happen in the Schedule C world, the small business division over there at the IRS side. So, oh, that's another thing. If you're reporting your STRs on Schedule C, you're doing it wrong. So, like 99% of people don't qualify for Schedule C. Most people qualify for Schedule E, but non-real estate CPAs tend to put that on Schedule C because they don't know better. Schedule C is only reserved if like you're legit taking that person out for like you're running a real bed and breakfast. Like you're cooking them food, being their tour guide, you're running a straight business that way. Like 99% of people don't. So, but so generally speaking, it's always on Schedule E. Yeah. Schedule C's will get you messed up for sure. That one, that because Schedule C's get abused, for sure.
Well, the good part is, didn't a ton of people get laid off from the IRS?
Yeah,
So
yeah.
YOLO.
Yeah, a new report just came out today that said 20,000 people that they gave 20,000 agents the choice to leave on their own will or ride it out and possibly get fired. And I think majority of them took it actually, because the other part was they're going to be reassigned for border patrol. Like,
That's totally different
yeah,
things.
that's what I thought. Can you imagine? Like you're an accountant, you go in, I'm an IRS auditor. And the next thing you know, you're just like chilling at border patrol with like a gun or something. I don't know. Like,
No, that's what I'm thinking. Is like, huh? I don't know. Imagining Tony having to drive all the way to Mexico for work, not doing
yeah,
taxes
yeah,
anymore. Like, you're not even properly trained for that. That doesn't even make any
yeah.
sense.
Like, man, these changes are crazy.
But then again, if they have actually a lot of the AI software to start detecting those, like that can, make their work a little
I
different.
think it's coming. Yeah, it's coming. The main part is the model that they're doing. They're trying to see, is it not sensitive enough? Is the model going to take on too much sensitive information? That's the issue. So they're trying to agree on what is right that AI can read into taxpayer records. Not related, but kind of related is the IRS is now releasing information to ICE about taxpayer information. So yeah, that's a very interesting and heated area too.
Mhm. That gives me a terrible feeling. Yuck.
Yeah. Yeah.
All right. Joseph has a question about the STR loophole. Does it only apply to domestic short-term rentals, or is an international one okay?
Unfortunately, man, the Australian one won't work. So just domestic. So it's the reason why is actually it's because bonus depreciation is only applicable for U.S. property. Yeah. Sad. This is all signs to stay here, man. We can't let you go. You're stuck here, bro. Yeah.
And the next question is, for the STR loophole, what are the major benefits you get to deduct against W-2? Does the 150K W-2 limit come into play?
Yeah, so in the STR loophole, yeah, you can deduct against as much W-2 income that you have and whatever you don't use, it'll be carried forward as a net operating loss. So, if you have like an 800K W-2 and you generate, say, a $200,000 loss, it'll bring down your taxable income to 600 grand. Let's just say you did a 200K, you have a 200K W-2 and you generate a 250K loss, that $50,000 that you don't use will become a net operating loss for next year. So then you'll take that 50K and reduce your taxes by that amount. So you can use as much as you have up to your taxable income amount, and then whatever you don't use gets carried forward on that side. And then the 150K part, the 150K is it is not relevant to it's a whole different like how do you say it? Can of worms. Like first you have like rep silo. Next silo you have is like STR. The 150K is like as long as you make less than 150K, it doesn't have to be an STR. Hey, give me an LTR, MTR, STR. You give me whatever you want. It will reduce your taxable income, but there's phase outs. So they give you 25K on the first 100 grand you make. So you have a $25,000 loss on your rental real estate, and you make $100,000. They'll give you the full 25K. However, it phases out, that 25K phases out 50% for every $1,000 you make. So at 150K, the whole thing's gone. But it's just say you're in the middle at 125K, then you'll get 12.5K of a deduction off against that side. So it phases out on that side. So that's where that sweet spot is. Like, when I used to live in Minnesota, it was good. Had a rental property, made 54 grand. My first year associate. And then I got fat refunds because I had a rental property that I bought. And then I just kept on deducting because I could get up to 25K as a loss. I don't think I had 25K loss. It was like an 80 grand property I had.
Damn. It's only $80,000 to get a property there.
Well, this was back in 2013. 2013. Yeah, 2013. Yeah.
Shit, I don't even know anyone can loan for that such small amount.
Oh, yeah.
Cool.
Yeah, dude, some properties, dude, during the crash in Minnesota, they're like 50 grand. Yeah, back in the day. Yeah,
That's
yeah.
a lot. Well, or I mean, like that's not like it's a very low, but it's like wow.
Yeah,
Okay.
yeah.
Is Jeremy in here? Because I want a clarification about your question. He asked, can you do an STR and then convert it into an LTR? Because the answer is yes, but how does this play into your question about the tax part?
Oh, my question was to claim the rep status, or not the rep status, but the short-term loophole status, and then convert it to an LTR.
Ah. So Tony, so to clarify his question is that can we start with doing an STR, doing all the setup and everything, get all the hours in, and then once it's set up, then convert to LTR?
Yeah, you can do that. Yeah, you can do that. The biggest part though is like if you can run it for like 2 years, it looks better than like running it as like a year and then shifting it over. It could be seen as a tax shelter, but once again, like there's a lot of facts. Like for example, like you try an STR, go and get people in. This thing's bleeding money. Like, dude, you have a facts and circumstances that show like I need to rent this out to pay my mortgage. So it's very fact dependent, but yeah, you can do that as long as there's like reason and cause towards it. But like I wouldn't say specifically buy it to do that. It may look a little bit weird, but also at the same time when you're doing your underwriting, you would probably want to like because STR numbers and LTR numbers are going to be a bit different when you're doing your underwriting.
Mhm. And that would benefit him for year one, and
Yeah,
while he's
year
doing
one.
it, and
Yeah.
then year two it goes back to LTR, and then by then, I mean, he would have taken a lot of the depreciation, everything out already too.
Yeah, most of it, especially if the tax code comes back to 100%. It wouldn't be hot if it stayed at 40% right now. It would not be good because then a lot of your 5-year and 15-year property is locked into that slower rate, so it wouldn't be as good. So really hoping the tax code comes back to 100% here. Otherwise, it's not going to be a pretty tax season for a lot of people.
Well, so actually that you brought up a really good question, because like if say we have something that we bought in 2024 and we already did the cost seg and start doing all the tax stuff, what happens when it comes back in 2025 and then it's restored to basically when we got it, and your depreciation is already set with the 40%. What happens at that point?
Oh, you have to follow the prior year rule. So you don't get a reset. So like if you have a property
No.
placed in service in 24 and you run a cost seg and it's at 60%, then the remaining 40% will be just over the useful life of the property. So let's say you had 100K
Yeah.
of 5-year property, you get 60K in 2024. And then that remaining 40K, you would have to get it depreciated over the next 4 years. So you get 10K each versus you had it in 2025 and it's 100%, you just get the whole 100K. So yeah, we extended the dude's return because he's in that bubble right now. He had like a San Diego property, and then we're like, I was like, dude, just wait and see what the tax code says because I don't really want to lock in $1 million property at 60% when it could just be like, yo, just wait till 25. Pay your taxes in 24. Yes, you have to pay a lot, but you'll get a way better benefit if it comes back to 100% this year.
Wow.
Yeah.
Oh, I feel really bad for all the cost seg folks this year then. They're
Yeah.
gonna be out of business for a year.
Yeah. It's tough. Yeah. No one's got like a crystal ball into all this stuff.
Yeah.
Yeah.
Right. And then the next question is, does the STR loophole unlock or allow you to use loss carried forward from past years.
Oh yeah. So SR unlock. Oh yeah. So past years are cemented in that, how do you say it? That nature. So let's just pretend like we had a rental property in 2023 and it was an LTR and you have passive losses. And then in 2024, you're like, I'm going to try my hand at STR. The 23 losses, they stay in the same category of how they were reported that year. So since they were passive losses, it will only offset passive income. And then in 24, say it's an active income, those prior losses won't help. So it won't unlock it. So like once you have it, it's just stuck in that year. So generally speaking, that's why you really don't want to run cost segs unless there's like a good reason why. Like number one, you're very profitable on other properties. Number two, you're gonna like have STR or reps, or you have a K1 that's really high. Or else just wait until you're a rep or STR and then run your cost seg. So generally speaking, that's the better way to do it. Just from milking out all the money you can.
That's right. Cool. So that's actually all the questions that we have. And then I noticed that there were a lot of questions tonight about the STR loophole. So just to give you guys a quick heads up is that we had a webinar on this on January 29th. So if you go look back up on SARE, like Subtle Asian Real Estate under YouTube, and go into there, the It Depends tab, you'll be able to find that recording. Because yeah, it sounds like everyone's like, shit, it's way too hard to become an RAP. I'm just gonna go get an STR instead. So yeah, refer back to that video. But I think that's all the questions we have. Any closing, Tony, about your 100% guarantee on all of our returns?
Yeah, I don't know about that, but yeah, if you need yeah, nah, I don't know anything about that, but no, it's good. I think I appreciate everyone's time hopping into this on that side. Yeah, if you want that guide, just DM me on Instagram, and then the automation should trigger. If not, I'll figure out why it didn't. So a little like REP guide on that side.
Cool. And then I will send you guys the recording probably around tomorrow or so. And then since this topic, we were actually supposed to do this next month, but we just got hella trolling. So we do have a new topic for next month. Next month, we're going to do more about strategic tax planning, because right now that, I know you guys are tired and stressed out from all the taxes, but you guys also paid a shitload of taxes already. So why don't we start planning and mapping out what our following year looks like, start implementing the tools that we learn along the way so we can start saving taxes. So we'll send out more information about that in our next email. But until then, thank you, Tony, and go and hibernate for the next week. Go to your man cave and get some rest.
Oh, we'll be in Florida, yeah. So
Perfect.
yeah.
Awesome.
All right.
Thank you, everyone. I'll catch you guys soon. Take care. Good night.
Thanks, Annie. Thanks, Tony. Good night.
Bye, Mike.